Wondering how to use a mortgage calculator to figure out what your actual house payment is going to be? Whether you're sitting in your living room running scenarios on a house you saw today, or you're months out from buying and just trying to understand the math, in the next few minutes, we're going to walk you through the exact mortgage calculator we use with our clients, field by field, so you can run any conventional or FHA scenario for any house, anytime, without having to pick up the phone. Here's why this matters. Last week, I had clients tell me they did not want their monthly mortgage payment to go over $2,200. They found a $300,000 home and they fell in love with it. They assumed they were in the safe zone. When we ran the actual numbers, the principal, the interest, the taxes, and the insurance, the real payment came in at $2,400 a month. That extra $200 made them stop and reconsider whether they could actually afford the house they were emotionally attached to already. Now, they ended up stretching for it because they decided it was worth it, but they had a choice because someone showed them the math before they signed anything. Most buyers do not get that chance. They fall in love, they get under contract, and then they realize they bought a house that makes them house poor. That is exactly what this video exists to prevent. Stick with me to the end of this video because I'm going to walk you through this mortgage calculator field by field, every single one, so that by the time we're done, you can sit down at your kitchen table, plug in any house you're considering, and make educated decisions about your family's financial future and your house shopping options. No lender call required to get started. Before we get into it, I'm Joe Nelson, team leader of the Nelson Home Group, Keller Williams, Kansas City North. I'm also a licensed mortgage originator and 21-year retired Air Force veteran. Our real estate team is the highest rated in all of Kansas City, and that combination of realtor and licensed mortgage originator matters here because it means you're getting both sides of this conversation from one person who actually understands how the mortgage and the home search fit together. We make these videos because we want to work with you. It's the whole reason we do this. If anything I cover today applies to your situation, please reach out. Our contact information is right below the video. You do not need to have everything figured out before you do. That's literally what the conversation's for. Now, let's get to the calculator. Head over to NelsonHomeGroupKC.com, hover over Buy a Home, and then click Mortgage Calculator. We'll also put the link in the description below so you can click straight through. Quick note before we dive in. This calculator is built to give you a really solid estimate of what your mortgage payment will look like, but it is an estimate, not a guarantee. Final numbers always come from a lender once they pull your credit, look at your full picture, and put the actual loan together. Do not make any final decisions on this calculator alone. Use it to plan, play with scenarios, and figure out what makes sense for your life. But talk to a lender before committing to anything. Cool? All right, let's get into it. The first thing you'll see across the top of the calculator is 4 buttons: VA, FHA, Conventional, and USDA. We're going to focus on Conventional and FHA in this video because that is what most of you watching are going to use. If you're a veteran and you want the full breakdown on the VA loan, we did a separate video last week walking through the VA side of this same calculator. The link is in the description. Let's start with Conventional. Click the Conventional tab at the top. The first field is home purchase price. This is just the price of the home you're considering, or your budget ceiling if you're still figuring out how much house you can afford. Plug in a number. Let's use $350,000 for our example today, which happens to be calculator default and lines up with what we see all the time in Kansas City. The next field is down payment, and this is where Conventional gives you a lot of options, so let me coach you through the trade-offs. The most common down payment on a conventional loan is 5%. It is the standard pathway for most buyers, and it is what the calculator defaults to. You will have private mortgage insurance, which we'll get to in a minute, but it's manageable. You can also go as low as 3% through programs like Home Ready and Home Possible. These are conventional loan programs with low down payment requirements, but they come with income limits and other qualifying criteria. They're not for everyone. If your income falls within the program guidelines and your credit is in a good spot, they can be a great way to get in a home with less cash up front. The catch is your private mortgage insurance is going to be a little higher at 3% down than it would be maybe at 5% because you're borrowing more relative to the home's value. Don't assume you qualify, ask a lender. They will know in about 10 minutes whether Home Ready or Home Possible makes sense for you. If you can put 10% down, your private mortgage insurance gets cheaper and your monthly mortgage payment drops. If you can put 20% down, you eliminate private mortgage insurance. That is the magic number. No PMI, lower payment, more equity from day one. And here's something most buyers do not know. If you can put 25% down, you may actually get a slightly better interest rate. There's something called loan level price adjustments that get baked into conventional rates based on your credit score and your loan to value ratio. Crossing that 25% threshold down can move you into a better pricing tier. It's not guaranteed and it depends on your credit and lender's pricing matrix and other things. But if you have already got the cash to put 20% down and you've got that extra 5%, ask your lender to run it both ways. You might be surprised. Okay, the next field is interest rate. This is where most people get it wrong, so pay attention. Do not, and I cannot stress this enough, do not Google current mortgage rates and plug in whatever number you see. Those rates are either flat out clickbait or they're base rates that do not account for what actually determines your real rate. Your credit score, your debt to income ratio, your loan level adjustments, the property type, all of it. You'll get a number that has almost nothing to do with what you're actually going to pay. And rates change daily. And no lender is going to lock your rate until you're under contract on a specific home. That's just how the process works. So if you're still shopping, do not expect a locked in number just yet. That is not how it works. What you can do is call a lender and ask a simple question. What are rates running today without any buy down costs added in? That gives you a clean baseline number you can plug into the calculator and play around. Be upfront with the lender that you understand the rate can and will move between now and when you actually lock it in. You're not asking for a promise, you're asking for just a real number to play with. One thing to know going in, most lenders are not going to give you a real quote without first having you fill out a loan application. They need to look at your credit and your income and debt picture before they can quote you anything that means something. So please expect that. A lender who throws a rate at you without ever pulling your credit or asking about your situation is not quoting you, they're guessing. Or worse, they're baiting you. Now, here's the tool that protects you in all of this. The loan estimate. That is a federally regulated document. Every lender has to use the same format. And in the top right corner, it tells you one critical thing, whether your rate is locked or still floating. This matters because when a rate is floating, a lender can put pretty much whatever number they want on that document and tell you whatever you want to hear to try to earn your business. Does that mean they're lying? No, it just means that floating is not binding. So you have to trust your lender. Make sure the numbers they're quoting are real in the current moment, and make sure you know whether that rate is the actual market rate today or whether it is a rate they got by adding points or buy down costs that you'll have to pay at closing. Those are two completely different conversations. Just last week, I had a refinance client get quotes from two different lenders. Both quoted her amazing rates. Both told her, don't worry, your cash to close is zero. But when I looked at the loan estimates, both of them had thousands of dollars in fees baked into the closing costs. They just financed those fees on top of her loan over 30 years without ever explaining it to her. And lenders do this all the time, especially the big telesales lenders. They tell you what you want to hear to win the business, and then magically things change later down the road. A good lender's job is to coach you to your best option, not bury fees in your loan and hope you don't notice. If you want a real number to work with on this calculator, call me. We're licensed mortgage originators, and that's exactly the kind of question we answer all day long. Okay, next field is loan term. The calculator gives you 30, 20, 15, and 10. Most people are going to compare a 30 and a 15. The 15-year rate is always slightly better, and a lot of YouTube guys will tell you to take the 15 and save on interest. I'm going to give you the opposite advice. Now, before you get me in the comments, stick with me. Always take the 30 and make a 15 payment if you can. Here's why. I had a client a couple of years back who took the 15-year mortgage to grab the slightly better rate and pay the house off quicker. Less than 2 years in, his job changed, his income dropped, and that 15-year payment was crushing him. He was forced to refinance, which cost him thousands of dollars in refi expenses out of pocket, and on top of that, when he refied, rates had gone up, so he got hit twice. He paid the cost of the refi and ended up at a worse rate than he started with, all to save 1/4 of a point on 15 years that he could not sustain when life shifted. When you take the 30 and pay it like a 15, you get the best of both worlds. You knock down the loan faster, you save on interest, and if life smacks you, job change, medical, divorce, whatever, you have the flexibility to drop back to the 30-year payment without refinancing. Flexibility is worth more than 1/4 of a point on rate, in my opinion. Next field is annual taxes. This is the field most people skip, and it's the single biggest reason their payment estimate is way off. If you want to know how much house you can afford, you have to get this field right. Here's the easy way to estimate. Take your home price and multiply it by 1.4%. So on our $350,000 example, that is about $4,900 a year in taxes. Now, that might be slightly high for some KC metro areas, but I'd rather you start high and go down than start low and get a nasty surprise. Here's the better move once you find a real house. Every single listing, Zillow, Realtor.com, MLS, all of them show the actual annual tax amount on the property. And it's usually right, but not always. So once you have a specific house in mind, throw that exact number into the calculator. This is the part where doing the math yourself actually beats guessing. The listing data does the work for you, and your estimate gets really accurate. The next field is annual insurance. For a starting estimate, plug in $2,100 a year. That works out to about $175 a month, which gets most KC homes in the ballpark across a lot of the price points. When you're ready to get a real number, we work with some incredible local insurance partners here in Kansas City who will give you an actual quote based on the specific home you're looking at. If that is helpful, just let us know. Happy to make that introduction. Now, we get to the field that matters most, the estimated PMI rate. PMI stands for private mortgage insurance, and it is required on conventional loans anytime you put less than 20% down. The calculator defaults to 0.85%, and that is perfectly reasonable, middle-of-the-road number for playing around and getting a feel for how mortgage payments work. But here's the thing you absolutely have to understand about this field. Private mortgage insurance on a conventional loan is one of the most variable inputs on this whole calculator. The typical range can be from 0.5% to 1.5%, and where you land in that range depends on your credit profile, your debt-to-income ratio, your loan-to-value, and a handful of other factors that the calculator cannot see. Let me show you why this matters. Take a $300,000 home, 5% down, conventional. Your loan amount is $285,000. PMI at 0.4%, which is a really good rate, is about $95 a month. PMI at 1.5% annually is about $356 a month. Same house, same loan, same down payment. The difference between those two PMI rates is about $261 a month. Over 5 years before you would hit 20% equity and PMI cancels, that is over $15,000 in payments. That is not a small number. That is the difference between a payment that fits comfortably and a payment that pushes you out of the market. So use 0.85% for now when you're playing around, but the moment you get serious, you need a lender to fill out a loan application, pull your credit, and give you a real PMI number to play with. There's no other way to really know. One more thing about private mortgage insurance on conventional. It cancels. Once you hit 80% equity, you can request to have it removed, and at 78%, it comes off automatically. That is a key difference between conventional and FHA, and we're gonna come back to that in just a minute. Now, look at the output box. The calculator gives you your estimated total monthly mortgage payment at the top. That is principal, interest, taxes, and insurance all combined. Below that, it breaks out the P&I, the taxes, and the insurance separately so you can see exactly where your money is going. And if you have private mortgage insurance, it will show you the estimated PMI dollar amount and remind you that it cancels at 20% equity. That's conventional. Now let's flip over to FHA. Click the FHA tab at the top. A lot of these fields are going to look very familiar. Home purchase price, interest rate, loan term, annual taxes, annual insurance, all of those work the same way as conventional. Same advice applies. So let me focus on what is different. First thing you'll notice, the down payment field now shows a minimum of 3.5% for FHA. That's the floor. The vast majority of FHA buyers go in at exactly 3.5%. A lot of them choose FHA because they do not have a big down payment to bring, and a lot of them choose FHA because of where their credit profile sits. Both reasons are common, and we'll get into that in the comparison section. You can put more down on FHA if you want to, and there is actually one specific reason you might. We'll cover that in a minute. But let's start with the standard 3.5% scenario, which is what the calculator defaults to. The big difference on FHA is what shows up underneath the standard fields. You will see a teal helper box that explains FHA's mortgage insurance. This is where FHA gets misunderstood, so pay attention. FHA charges two separate mortgage insurance fees. The first one is called upfront MIP. It is 1.75% of the base loan amount. The calculator rolls it into your loan automatically. But here's the way to actually think about what's happening. And it's not exact to the dollar, but it'll help you understand it. If you're putting 3.5% down on FHA, that upfront MIP is essentially eating half of your down payment. Yeah, technically the calculator is rolling it into the loan, but it's really doing is taking your loan to value from 96.5% up to about 98.25%. Half of the down payment you just brought to the table went to upfront MIP. That's a real cost. You're financing it over 30 years, which means you're paying interest on it for the life of the loan unless you refinance or sell. The second FHA fee is called annual MIP, which gets paid monthly along with your principal and interest. And here's the rule almost nobody tells you. If you put less than 10% down, your annual MIP is required for the life of the loan. It does not cancel ever. The only way to get rid of it is to refinance into a conventional loan once you've built enough equity. If you put 10% down or more, your annual MIP cancels automatically after 11 years. That's worth knowing, but honestly, most FHA buyers don't keep the same house for 11 years anyway, so for most people, that is not a major game changer. For some buyers, it does matter, so it's worth running the math. But do not let it be the thing that drives the decision. Now, let's talk about the difference between PMI and MIP because they sound pretty familiar, right? MIP stands for Mortgage Insurance Premium. PMI is Private Mortgage Insurance. It's on conventional. It varies widely by your credit profile. It cancels at 20% equity. MIP, Mortgage Insurance Premium, is on FHA. It's a flat rate that does not change based on your credit. With less than 10% down, it's there for the life of the loan. That is the structural difference, and that is why this comparison matters. So how do you actually decide between conventional and FHA? Honest answer, you do not decide. You run both scenarios on this mortgage calculator and you compare them apples to apples. That's the whole point of this tool. Here's the framework I use with clients. There's pros and cons to both, and the right answer depends on two things: what your private mortgage insurance would actually be on conventional, assuming you qualify for both, and how long you plan to stay in the house. Scenario 1, your PMI on conventional comes back high because of your credit profile. In that case, FHA's flat MIP rate might actually save you money month over month, even with the upfront MIP factored in. This is why a lot of buyers end up choosing FHA. The math just works better for their situation. Scenario 2, you're not planning to stay in the house long term. Remember, the FHA upfront MIP is essentially eating half your down payment. If you're only going to be in the house a couple of years, that upfront cost is eating into your equity from day one, and you probably will not recoup it before you sell. In that case, paying month by month PMI on a conventional and selling before you build much equity might actually cost you less overall. But here's the catch. You cannot run this comparison accurately until you have the real PMI number for the conventional side. The 0.85% default on the calculator is fine for a first pass, but the real decision needs real numbers. That requires a lender to fill out a loan application, pull your credit, and run the math for you. There's no shortcut there. I'm planning a full conventional versus FHA breakdown video down the road that goes deeper on this topic. For now, the high-level way to think about it is this: run both, compare them, and bring real numbers into the conversation when you're ready to make a decision. If you want to go deeper on understanding mortgages and the home buying process, we have got a full playlist link below. And if you're a veteran specifically, the VA calculator video we did last week pairs perfectly with this one. I will link it right in the description. So now you've got it. How to use a mortgage calculator the way it should be used, practically, with the actual math on a tool you can pull up anytime. You can run any scenario, any house, anytime without picking up the phone. That is the freedom this calculator is built to give you. Head over to nelsonhomegroupkc.com and start playing with it. Plug in different prices, plug in real listings, toggle between conventional and FHA, play with USDA if you think you might qualify. Get a feel for what fits your life before anyone tries to sell you on what fits theirs. And if you have specific questions, want to chat about getting pre-qualified, or want to talk to a realtor on our team, scroll to the bottom of that same page and fill out that contact form. We get those. They come straight to me and we respond personally. Here's the thing, we make these videos because we want to work with you. It's the whole reason we do this. So 3 doors are open to you depending on where you're at. Door 1, if you need help with a mortgage, conventional, FHA, VA, USDA, we even have down payment assistant program options. Any of them, call us. I'm a licensed mortgage originator. That's literally what I do. Door 2, if you're looking for a home in Kansas City, our real estate team is the highest rated team on Google in the KC Metro. We'll take care of you. And door 3, if you're outside of Kansas City, our mortgage team is licensed in nearly all 50 states, and we have a national network of trusted realtors we work with all over the country. Tell us where you're going, and we will connect you with someone vetted and trusted in your area. You can reach us right through the links below this video. Call the number, email us, or head over to the website. Whatever is easiest for you, we will be there. Don't sit on this. Whether you're shopping today or just dreaming about it for next year, the more you understand the math now, the more options you'll have when you're ready. I'm Joe Nelson with the Nelson Home Group. Let's get to work.